This is a financial analysis of UPS versus FedEx by Fernando Martinez, Edgar Rosales.
First off, who are the shareholders? Shareholders are investors that own percentages of a company, which provide investment capital for companies such as UPS and FedEx. FedEx has 265 million shares outstanding, and the top 10 institutions listed above hold almost 37% of the shares, while UPS has over 695 million shares outstanding, with the top 10 institutions listed above holding almost 32% of those shares. The top 3 institutions for UPS are in the top 5 institutions.
Why do investors care about our cost of capital? From an investor standpoint, a company's cost of capital is essentially the amount of capital raised through either debt or equity to generate revenues through products or services. Investors use a weighted average cost of capital from both debt and equity financing of a company to reach their own required rate of return. A company's overall cost of capital is a mixture of returns needed to compensate all creditors and stockholders. There are advantages to having debt, though, like tax savings. Interest expenses are deductible, but cash flows are not.
Next, what is our cost of debt financing? Using the U.S. 10-year Treasury note, we determined that the risk-free rate for both companies would be 2.66%. FedEx has a Moody's bond rating of Baa2, while UPS is A1. Both companies have a blended tax rate of 29.2%, and given the rest of the numbers above, the after-tax cost of debt for UPS and FedEx are 2.27% and 2.78%, respectively.
What is our cost of equity financing? Cost of equity is a required rate of return that investors seek for investing into a company. Investors seek a rate of return depending on the risk factor associated with the investment in the company. We choose to use the capital asset pricing model to calculate the cost of equity because it takes into consideration the risk level associated with an investment against the market. The values listed above help us determine the respective cost of equity for each firm. The cost of equity for FedEx was 7.11%. The cost of equity for UPS was 7.91%.
Next is, what is our overall cost of capital? We calculated the debt ratio for UPS to be 19.96%, making the equity ratio 80.04%. Using these numbers and the previously stated calculations for the cost of debt and equity, we can calculate the weighted average cost of capital. Using the above WACC formula, we calculate UPS's weighted average cost of capital to be 6.78%. And for FedEx, the debt ratio is 41.98%, making our equity ratio for the remaining 58.02%. Using the cost of equity and debt stated above, and using the formula for the weighted average cost of capital, we got their cost of capital of 5.29%.
Could we lower this by changing our capital structure? As you can see for FedEx, when the firm is operating at the optimal level, beta and cost of equity both increase, therefore shifting the WACC to grow as well. For UPS, the WACC decreases. When the cost of equity for a firm increases, this pushes the WACC of a firm to increase, also because the new financial risk of equity investments is higher. In the cost of capital calculation table shown, as the debt ratio increases for the company, then the cost of equity and the debt increase. This causes the cost of capital to decrease, resulting in the company being valued higher, with its highest value being at the optimal 60% debt ratio.
Would more debt create unnecessary risk? Yes. For UPS, restructuring the company to take on more debt would give the company a worse bond rating and would increase its beta, as it would be seen as a riskier investment. Once the company passes its optimal debt ratio of 60%, its enterprise value can quickly decrease, and which would also decrease the flexibility a company has on spending large amounts of money. For FedEx, creating more debt would increase the beta and make the company a riskier investment as well, and the WACC would also increase.
How would a financial restructuring affect the value of our company? For FedEx, by moving to a 60% debt ratio, we can see the enterprise value of the company grows perpetually in the future, and the cost of debt is reduced. Our WACC increases because our financial restructuring poses another investment risk to investors because there is an uncertainty of whether the firm will perform more efficiently or not. For UPS, moving to a 60% debt ratio would see the enterprise value of the company at its highest. This is caused by the decrease in the cost of debt as its ratio increases and an increase in the cost of equity.
Next, what does the competition do? UPS and FedEx are the 2 biggest companies in this sector. We chose Expeditors International of Washington and C.H. Robinson Worldwide, Inc. for comparison. As shown in the table above, they are much smaller than UPS and FedEx, with less than a tenth of their total assets and liabilities.
Is our stock price fairly valued? The current stock prices for each company is listed above, and if we were to operate at the optimal debt ratio of 60%, we can see that both stock prices are undervalued currently.